Good morning, Jags. This is Fahad. Today is Tuesday, July 7th. Let's get started. Okay, so two things I'm going to discuss real quick, and then I'll pass the torch to my team here. Looking at two charts this morning. The first one is CyrusOne, CONE. Have my eyes out for a potential breakout through $77.50. So setting a trigger right here in front of you and see if this thing can crack through 77.50. And if it does, then I think this thing is going to get to low to mid 80s. Haven't seen any kind of much pickup in the option activity for quite some time. It's been rather quiet. But similar to the bull case that we have already presented previously in another digital REIT, which is CoreSite, symbol COR. Same kind of dynamics are also play in CyrusOne as well. And actually going back to CoreSite, this too has a similar technical setup for a breakout as well after recently completed its secondary share offering. Changed the guidance a little bit, and now the stock can gradually start to lift higher. So CoreSite has a technical breakout through 127.50, and the one that I'm adding to my list for a potential breakout story is CyrusOne, with 77.50 being the trigger. Now, the simple reason for this, instead of getting bogged down with a lot of detail, is that we continue to see, and a lot of these thoughts were presented in the third quarter outlook as well. We continue to see that the data center REITs are benefiting from stabilizing pricing, potential industry consolidation, improving leasing trends for the REIT structures they provide. And then more importantly, there's a lot of visibility right now with regards to leasing and funnel, given that the hyperscaling activity, which is really from the three big, large public cloud, that's Amazon, Microsoft, and Google, the hyperscaling activity continues to pick up. It was picking up before COVID-19 happened on improving CapEx trends, and COVID-19 basically accelerated those trends by some of the largest cloud customers, as basically we fell into this data-driven economy. So as long as this data-driven economy continues, which has benefited so many companies, both of these the digital REIT stocks, in my view, are technically setting up for breakout and more to come. We're also seeing, in some cases, some anecdotal evidence, particularly related to CyrusOne, and I'll discuss more of this later in the chat room or in today's webinar, that some cloud customers are asking for early delivery of capacity under contract. Basically, there's a little bit of a concern that the data-driven economy is going to a level where they're going to start to run out of the actual capacity everywhere. And so as a result, they want to lock in the next 5 years or even longer of capacity under contract with today's prices right now. And so that's also positive in terms of its book revenue outlook going forward. Enterprises are finding real-time gaps in their IT infrastructure due to capacity and geographic constraints. So just keep this in mind. CyrusOne, in my view, sets up for a breakout through $77.50. Next one is one of our top picks from previously that we brought in the quarterly outlook more than a year ago. Taking a look at this again, which is IQV, IQVIA Holding. I think that's how you say it, IQV. The stock has a minor correction after stalling around $155 per share. Since then, it has moved down, formed a base and is starting to lift higher from that base again. And if you look closely, there's a MACD bull cross, there's an RSI bull cross. So this thing is actually setting up for a next leg higher from here. They should carry the stock all the way through 155 minimum. So that's about $10 to $12 to the upside. And if it clears that on decent volume, then I believe we will see a new 52-week high in IQV through $170 per share. Now, as you all know, I'm always a big fan of buying great companies on pullback. So this has that technical view. One could step in over here with a hard stop at 134. So basically a low risk entry for a new leg higher and a rally back up to all the way to new 52-week high. I bring this up because in terms of the in terms of all the contract research organizations or CROs that we have discussed many times, they benefit when the clinical programs for drug development by large pharmaceutical companies as well as biotechs go up. The more the capex that's involved in drug development efforts around the country, the more CROs, contract research organizations, help because they basically outsource that entire part to the CROs, and then they get paid for that business. And so the revenue outlook, as well as the just the overall trajectory of revenue trends generally tend to move higher whenever the capex is rising. Bank of America has a very beautiful take out this morning, and they're talking about it's remarkable that the biotech financing has raised $75 billion in the first half of 2020 so far. And if you look at this chart closely, you'll see yourself what this means. These are full year bars that you're seeing in terms of billions of dollars. And just year to date, we have already seen in the first half through June 2020 already at 75 billion. By the time this year is over, the total amount of capital that the biotechs would have raised would probably reach $100 billion or more. And if you look at what are the reasons for this, where's the capital coming from, and where the money is being spent, it's coming from a lot of secondary share offering. It's coming from debt offering. It's coming from venture capitals, which represent 21% of the total equity funding. It also coming from the new IPOs and so on and so on. But a very large chunk of this is being spent on, no surprise there, COVID programs. Up until 2 months ago, there were about 75 companies globally that had started some sort of clinical development program to create either an antibody test or some sort of serology test, or to start working on a vaccine for COVID-19. Now, globally, more than 120 pharmaceutical companies / biotech companies are working on COVID. So they're spending a ton of money and related to COVID as well. And where's all of this business going as they spend all this money on these programs? If they do not have the R&D budgets or R&D departments themselves, because many of these biotechs tend to be very small in nature, they're spending all that money by outsourcing the business to companies like IQV that are then benefiting from, by running the actual clinical programs for them, the drug development, the testing, and all of those. By the way, IQV does not control the data. They simply do the testing, they simply do the clinical programs for them. So this is a very, very strong bullish picture that is painted over here by Bank of America for IQV. And so I expect the stock to gradually go back up to 155. And if it clears that, then I think we see 170 in the long run. Chronicle.
Morning. So I have a continuation of the e-commerce theme. So previously talked about UPS, which was a direct play on the theme, and I also talked about Rexford, which is a last mile logistics play. Both of these ideas were more of a value kind of setup rather than growth. And right now I'm watching Manhattan Associates and waiting for a pullback to possibly get long, symbol MANH. This is another possible play on logistics, but unlike UPS and Rexford, this is more of a growth name. Surprisingly, not very well covered by sell side. But what this company does is it provides software solutions for supply chain and omnichannel operations. They are the market leader in this category. Basically everything from warehousing, transportation, point of sales, order management, even supply chain CRM. And a major driver of their growth over the last couple of years has been the switching of their business to becoming a software as a service model and cloud model. There's no immediate catalyst, but I just wanted to point out 3 things about this company. First off, they have no debt on their balance sheet, which is probably why the stock recovered very quickly following the March crash. And secondly, the company about a month ago introduced a new cloud warehouse management system. what makes this offering unique is that it is the world's first cloud-native enterprise-class system, which covers every stage of distribution, and it will never need upgrading. So now they have the first mover advantage in this respect. And the offering comes with a lot of modern features like machine learning with respect to communicating with machinery and warehouse robots, as well as AI-enabled order streaming. So the software basically uses prediction models to prioritize orders and allocate inventory. And there's also voice integration plus support for Internet of Things technology. On top of all that, it's all scalable and clients can pick their features. So for example, a big customer like Walmart or Walgreens or CVS, something along those lines, they can basically subscribe to Manhattan Associates' entire package to be implemented on a large scale. Meanwhile, a smaller private warehouse company can subscribe to just some of the features and still have the core package. So I think this new offering will drive the next leg of growth. Lastly, with a market cap of just 6 billion, I wouldn't be surprised if this company becomes a takeover target in the future. I can totally envision a scenario where Salesforce, SAP, or even IBM decide to buy the company. Unlike other software companies, this Manhattan Associates is a consistently profitable company every year. So they're going to demand a high premium, and buyers in the software space tend to overpay anyway. So technically, the stock is looking a bit overbought with a bit of RSI bearish divergence on the daily chart. And I'm anticipating a short to medium term pullback to the mid 80s. Like I said, there's no catalyst at the moment, but I'm just keeping it on the watch list.
Yeah, I was just gonna say I would much prefer a pullback to about 85 to step in. Nice bull case over there. Um, if it comes into 85, and you know this is quite normal actually. A lot of people like to chase breakouts on when things move to new 52-week high, but quite often you get better reward, risk and reward in your favor when you see something running strong, reaching new 52-week high. You wait until that pullback comes to the VOP support lines. In this case, that would be about 83, and then you step in. So basically slightly off from the 52-week high, and that allows you a far better, lower risk entry with hard stop. So I would prefer to do the same thing on Manhattan Associates, but interesting one. Jay.
Hey, morning, Fahad. So today, I just have one name, and that is cytosorbents. The ticker is CTSO. This is a healthcare company that specializes in blood purification to control and reduce inflammation in critically ill patients. And essentially, this is a COVID play. Last week we got a positive note from Wells Fargo on Becton Dickinson, and then yesterday, Thermo Fisher provided a business update for Q2, a positive update just related to COVID sales essentially. And when you look at shares of CTSO on the Q1 earnings call, management noted that it expects Q2 product sales to exceed the Q1 levels. And according to B. Riley in their note last week, this was one of the few times management has provided any revenue guidance. And obviously they believe, it's related to the momentum in COVID sales. And when you look at what had occurred after Q1 in Q2, you saw in April, they received emergency use authorization from the FDA for COVID patients. In May, Biocon, which is one of India's largest biotech companies, they received approval for the emergency use of this CytoSorb product for critical COVID patients. And then a couple weeks ago, the company announced the commercial launch of the CytoSorb product in 9 Latin American countries. So I'm actually going to write a little bit more about this today and post it on the homepage for everyone to read.
Great stuff. So this was a preview to a write-up that will be published on homepage later.
Yep.
Looking forward to it. There's so many COVID players out there, so sometimes
Mhm.
it just spins my head. I'm like, okay, so which one is better? Which one is catalyst driven? But like I said, I think almost every day there's 5 or to 10 stocks that are just on the radar that are moving sharply on COVID theme one way or another. Looking forward to your article. Thanks for that preview, Jay. Avo.
Looking at IOVANCE, IOVA, I had talked about it in, I think it was mid-June or early June, perhaps.
Doesn't this have like bunch of September call accumulation recently? I
Yeah,
looked at all of
exactly,
it.
and that's why I bring it up, because on Thursday there was another about 900 September 30 calls bought, and this is, I believe, is targeting a um, a readout for their come on, speak, Avo. It's cervical cancer therapy readout that is expected sometime in September is the best that I can figure out. It's a little murky on the date, but I think this is what it's targeting. The company continues to have positive results in their testing. I like this stock. I think it's worth a shot because it's not overly expensive in terms of the price of the options, and I don't think it's crazy high implied volatility either. So there was in February, there was some rumors that the company was getting ready to be bought out, or at least putting itself on the market. But then in late May, they did a secondary, which kind of takes that away. So that's why that dropped there in late May that you see. But otherwise, looking through the data, I think it's got a very good shot at being even more successful with the next set of data.
Yeah, I would like to see more color on that clinical update that is expected, the upcoming data. Basically, in terms of biotechs, the best way for me to gauge whether something is going to be as good as previously expected is when we have a easy, clean trend looking at the prior data points, whether they have been better than expected and whether the company is on the path to continue to beat that. So usually a simple review of prior studies can improve the confidence for entry. I have seen tremendous amount of call accumulation in this one, all the way out to 50 strike. And so all of the September call options, and purely technically speaking, I think what has kept the lid on the stock is really the secondary offering, which is now absorbed. So we'll see if this thing starts to clear through 30. Downtrending resistance, and if it does that, then it opens air pocket up to 32 in short term, and then who knows beyond that how high this can fly. So I'll be keeping an eye out, and let me know if you have more color at some point, and we can share with clients in the chat room or webinar about what to expect from this data based on prior studies that we have seen. All right, good stuff, guys. Thank you everybody for joining. Short and sweet and to the point. We will see you in the chat room shortly.